Every year, the average American household shells out over $8,000 on insurance premiums. But here is the uncomfortable truth that the industry counts on you never figuring out. Most of that money buys protection you will probably never actually need, while the coverage that could genuinely save your family goes overlooked. To understand how to win at insurance, you first have to understand how the industry makes money. Insurance is not complicated. At its core, it is a bet. You are betting something bad will happen. The insurance company is betting it will not, and they are very good at this bet. The entire business model is built on something called the law of large numbers. If you insure one person, their health outcome is unpredictable. But if you insure 10 million people, the statistics become extraordinarily reliable. Insurance companies know with terrifying precision how many of their policyholders will get into car accidents, develop cancer, or die in a given year. And because they know this, they price their premiums slightly above what they will actually pay out in claims. Then invest the float, the money sitting between when you pay your premium and when you make a claim. This is called underwriting profit plus investment income, and it is why insurance is one of the most profitable industries in American history. Most people buy insurance the way they buy extended warranties, out of fear, without understanding what they are actually getting. And insurance companies count on this confusion. They make more money when you are confused. The first thing you need to understand is the difference between two types of risk: catastrophic risk and routine maintenance costs. Insurance should cover catastrophic risk only. When people start using insurance for routine things, like small car repairs or frequent doctor visits, they end up paying far more than they save. Life insurance is where most people make their first major financial mistake. Walk into any insurance agent office, and here is what often happens. You say you are looking for life insurance, and they immediately start showing you whole life or universal life. Products with names like permanent protection and cash value accumulation. Here's what they are not telling you. Whole life insurance typically pays agents commissions of 50 to 100% of your first year premium. Term life insurance, which is almost always the better choice, pays much lower commissions. So when an agent steers you toward whole life, they are often steering you toward what is best for their paycheck. The math is simple. A healthy 35-year-old man can buy a $500,000 term life policy that pays his family $500,000 if he dies, for about $25 a month. The same death benefit in a whole life policy, easily $500 a month or more. The pitch for whole life is that it builds cash value, like a savings account inside your policy. But here is what they do not say clearly. The returns on that cash value are typically 1 to 3% annually, far below what that same money would earn invested in a simple index fund. The rule is simple. Buy term life insurance for the years when your family depends on your income. If you have young children, significant debts, or a spouse who could not maintain their lifestyle without your income, get term life. For most people, a 20 or 30-year term policy is all they ever need. Health insurance in America is its own complicated language, and most people never learn to speak it. Let us decode the key terms that actually control how much you pay. Your deductible is the amount you pay out of pocket before insurance kicks in. If you have a $3,000 deductible, the first $3,000 of your medical bills each year comes directly from your wallet. Your out-of-pocket maximum is the most you will ever pay in a single year. Once your costs hit that ceiling, usually between $7,000 and $14,000, insurance covers 100% for the rest of the year. Between those two numbers is a zone called cost sharing, where you pay some percentage and insurance covers the rest. This is where co-pays and co-insurance live. If you are young and generally healthy, a high-deductible health plan paired with a health savings account is almost always the smarter choice. You will pay lower premiums, you will contribute pre-tax money to your HSA, and that HSA money rolls over every year, building a tax-free medical emergency fund. The mistake is buying a low-deductible plan because it feels safer, but then never actually hitting that deductible because you are healthy. You have paid thousands of extra dollars in premiums for coverage you didn't use. The real purpose of health insurance is catastrophic protection, major surgery, a serious illness, a hospitalization that would otherwise bankrupt you. Make sure your network is solid, Your out-of-pocket maximum is something you can survive, and consider an HSA if you're eligible. Most Americans are either overinsured or underinsured on their cars, rarely anywhere in between. Here's what you are actually buying when you pay your auto insurance premium. Liability coverage is the most important. This pays other people damages when you cause an accident, their medical bills, their car repairs. Most states have minimum liability requirements, but those minimums are dangerously low. If you are in a serious accident and only carry the state minimum, you could be personally sued for damages beyond your coverage limit. Experts recommend carrying at least $100,000 per person and $300,000 per accident in bodily injury liability. If you have significant assets, consider an umbrella policy on top of that. Collision coverage pays for damage to your own car in an accident. Comprehensive covers things like theft, weather damage, and hitting a deer. Together they can add significantly to your premium, and here's the key insight. If your car is worth less than 10 times the annual cost of these coverages, you might be better off dropping them and self-insuring. The biggest mistake people make in auto insurance, they focus on getting a low premium instead of building the right coverage. Do not shop for cheap auto insurance. Shop for the right auto insurance with the lowest premium for that coverage. So here's how to build your coverage stack the right way. Think of insurance as a hierarchy. At the base, your catastrophic coverage, liability insurance that protects your assets, health insurance that prevents medical bankruptcy, and if people depend on your income, term life insurance. At the next level, mid-tier protections that make sense given your specific situation, comprehensive and collision on cars you still owe money on, renters or homeowners insurance, which covers the structure, your belongings, and critically personal liability. At the top, specialty coverage that fills genuine gaps. Disability insurance, which most people overlook, is actually one of the most important. You are statistically more likely to become disabled than to die during your working years, and yet far fewer people have disability coverage than life insurance. For every insurance policy you own or are considering, ask 3 questions. First, what specific catastrophe am I protecting against? Second, if that catastrophe happened, would my current coverage actually be enough? And third, am I using insurance for things that are not actually catastrophic, things I can self-insure by building an emergency fund instead? Insurance is supposed to be a financial tool, not a source of fear or confusion. The companies and agents who benefit from your confusion will always try to make it more complicated than it needs to be. But now you understand how the machine works, and knowing that is worth more than any policy ever written. If this breakdown helped you see insurance differently, subscribe to Insure Smart. Every week we break down financial systems so you can use them instead of being used by them. Drop a comment below. What question about insurance do you still have?